Welcome to the January 23rd, 2023 Advance Report from McGowanGroup clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman, with your weekly fast-paced tour of the global financial markets. Today we've got some special investment lessons built in from the last 35 years. I actually started in 1986, and I'm going to cover some of the things that I've learned over that time period that can help you make great decisions. I'm also president of McGowanGroup Asset Management, a wealth management team of 10 based right here at the Crescent in Dallas, serving affluent families across the country. We look forward to our brainstorming session, and if you want to trigger a brainstorming session by Zoom or a brainstorming session with a tour of the office, just go to NetWorthRadio.com and click the button and it'll let you sign up, and we'll be right back in touch. All right, so I wanted to cover history and lessons in the career. Well, this is 1986 to 1999. I broke my history in the business into 3 different time periods. What's that right there? That's the crash of '87. Now, there's a lesson built in here. This actually took the better part of 2 years to recover. If you had left town at the end of '87 and come back at the end, you would have concluded that not much happened. But the equity skyrocketed, and then in a single day went down 20%. The peak to trough correction was a little more, but actually from the beginning of the year till the end, equity finished about the same. And we keep hearing about the '87 crash. Now, you could get 10% on a US Treasury at that point, and of course that put pressure on stocks. What you can see from here to here, the Dow finished this 13 years at 11,500 on its way to 12,000. Well, relative to what was happening back here, longer term, it was wise to own great assets and keep compounding. Here's the 1990 recession. Here's 94 when they raised interest rates aggressive. That sound familiar? What was the lesson? Buy great stuff while they're raising rates and you're having a bear market cycle, and then allow those assets to compound. Here you could see the late 90s. Tech stocks. This is a big lesson. One, we didn't have enough tech stocks, but we made up for it because the stuff we had was great. We learned about emerging market bonds paying 15% interest at a deep discount, and that's what we loaded up on. Zero coupon treasuries were quite attractive as the Federal Reserve raised interest rates in '99. So we increased the forward reliability of the portfolios. And here's the tech wreck. We go from 2000 to October 8th of 2002. It was miserable. All the tech stocks collapsed. The NASDAQ went down 80%. Wow, that's huge. And what actually made money during this time period? By the time you got over here, equity had not recovered yet. The NASDAQ was still down by half, but energy had doubled. Wow. So being in the right sector is important. You could see the huge 05, 06, 07 run up, and then you see the Great Crisis. Wow. Now, the equity didn't recover until 2012 from the Great Crisis. We recovered in about 9 months because, again, during crisis, we like to buy up great stuff, and that included lots of bond funds paying 15% in the high yield category that were close to half price at the low point. You could compound that, and it recovered us faster. So that was an important lesson that we had learned back in this wreck. Here we go. So looking forward, this is 2013 to 2023. Why did I pick that time period? Well, that's the market that most people can remember. This is coming out of the crisis. The Dow's about 12,000. Economy began to grow. We started buying dividend stocks, good ones, because earnings were growing and they were raising the dividends. That turned out pretty well. You can see 15, 16, we kind of had an artificial crisis. It was an artificial credit crisis. Everybody thought there were going to be lots of defaults. There weren't. And things took off in 17. Deregulation, lower taxes, great for the economy. This is the Fed cycle. Don't forget this. 2018, the Fed started raising rates, right? Because they didn't want inflation. Very similar to what they did last year. And you could see we had a bear cycle, down 20%. What happened right here? They said, you know, we think we're done, almost done. They raised rates maybe one more time, but things recovered. Earnings peaked in 2018, and here's 2019. We had a great market, but companies actually made a little less money in 19. That could happen this year, but notice as we started to price in a lot of the technology stocks and their growth rates, the whole index went up. There's the pandemic. There's the amazing recovery. And here is the crisis of 2022. So far this year, a nice rebound in the Dow from that low point. But the lessons being own great assets and restore tactical safety during high points, which is what we did in 2021. We had a nice reserve, we could buy up bargains, and this little rally right here overall has taken us to a new level of profitability as opposed to being at a 30% loss like the NASDAQ. All right, everybody's worried about the economy. Is it going to be a recession? There's the 2020 minus 3%, 2021 6% growth. That's amazing. And 2022 is actually forecast, or was 1.9%. 2023 is just 0.4%. That's growth disappearing. But it may not be a recession because 0.4% is actually positive. So as we go forward, the likelihood of a severe recession versus something just right where growth slows way down, but inflation 6 months ago, we covered this last week, it's worth watching again. Inflation for the last 6 months has annualized at only 1.8%. In other words, it disappeared in July. Well, what's going to happen to corporate profits? This is quarterly GDP. I'm going to skip that. Here we go. Look at this. S&P 500. This is how much money those companies make. And you can see there's a contraction in profit that happened last year. What happens from here? Earnings expectations are low. And economic growth in the fourth quarter from the indicators we used was actually more than expected. So you start to see corporate profits move up again here in 2023. That's good news if you're in the right spots. And that's our job at McGowanGroup Asset Management, to make sure the portfolios are providing generous cash flow and in the right spots for potential long-term appreciation. Thank you for tuning in. Go to networthradio.com. You can contact us there. We look forward to hearing from you. Thank you for tuning in to Net Worth Media today and our efforts over the past 2 decades to educate clients and help clients make great decisions. That's the reason that we're here at YouTube McGowanGroup, Apple Podcasts, Net Worth Radio, and networthradio.com. The Net Worth Media effort is designed to help you make great decisions and address value at risk of loss, fluctuation in the markets. Remember, if we talk about a security, doesn't make it a recommendation until you come down and get a plan from McGowanGroup Asset Management, the team that cares. You can set a Zoom meeting or an in-office meeting at the Crescent, and we'll give you a written plan that encompasses what we believe to be the best allocations. This is a team of 10 devoted to you. That includes the research that you see each week from Reuters, from Bloomberg, and from the best sources. We always post links at networthradio.com for what we believe can help you make great decisions, the research that comes up. Now, the Net Worth Media effort is also designed to address cycles in the market, value at risk of loss. at networthradio.com. You can get the ADV form that shows, yes, we're a fiduciary, a registered investment advisor. It covers the costs of hiring our team to help you in the future ahead. It really helps to have an expert team on your side that you can reach by phone, email, and of course, a team that's here for you every week to address what's going on in the markets, because anxiety can often lead investors to make decisions that are either dangerous, chasing things, or selling things when they shouldn't. And that's a big part of our planning effort at McGowanGroup Asset Management. Thank you for tuning in, and we look forward to serving you and your family in the years ahead.